Join us now with what to buy when rates are high. Joanne Feeney, she's a partner and portfolio manager for Advisors Capital Management. How'd you like to be Jay Powell, Joanne, where you're trying to get, basically you want to get the whole yield curve up. So you say stuff, the short end goes up, but it may affect the long end the opposite way because it means the landing, whether it's soft or hard, could be harder than you previously thought. Everything is so counterintuitive. I don't know. People at home, I don't know what they're just scratching their head with what we talk about most days.
Yeah, Joe, you're absolutely right. It's a very unusual situation. We don't have recessions in history that match the preconditions that this one has. And that's why the Fed is in such a tough spot. I would not want to be Jay Powell. But for investors, you have to look at that mix of challenges, right? The high inflation now, rates moving higher and likely to stay higher for longer, plus a potential of a recession and therefore lower earnings growth, lower sales growth, which makes equity investing challenging. And so, what we are looking at for our clients, particularly the ones looking to be in retirement, they need the cash flow. We have several higher income strategies that mix together fixed income and equities, because equities could do a lot that bonds cannot do in this kind of environment.
Right. We know about the yield curve and how it can forecast a slowdown or a recession. If the inversion gets higher than, now it's over 100 basis points, the highest since I think 1981, does the size of the inversion, is that an accurate forecast for how deep the recession is? Or,
no.
I mean, if he has to raise them higher because the economy's so strong, then it seems like that could be a good thing, that you can raise rates a little, tackle inflation, and maybe the economy survives.
There's several things going on, one of which makes it very difficult to use the inversion of the yield curve as a real signal of recession. What, though, the market is saying is that they're betting on a recession. That's what the yield curve is telling us. And that the inflation problem is viewed as a short-term problem, which is so therefore you'd expect near-term interest rates to be higher than long-term rates. If inflation comes under control, then the 10-year has built into it a 2% inflation rate, not a 5 or 6 or 7% inflation rate. So the yield curve makes sense from the path of inflation's perspective. But it's challenging for equity investors because of that fear that, it's very challenging for the Fed to get this under control, and they could risk constraining consumer spending so much that we end up in a recession. But right now, remember, the consumer is pretty resilient. Real disposable income has been rising for several months. Retail spending out this morning, the data from MasterCard, for example, shows that retail spending has been keeping up and, in fact, a bit ahead of inflation. So consumers are out there still spending, which makes the Fed's job even more challenging.
But you have been, as you say, beating the bushes for two things. You like some yield, some dividend, and the potential for some capital appreciation. So a total return portfolio, and you found which areas and which stocks.
Yeah, Joe, so the idea here is that bonds can only get you so far. I mean, the coupons on bonds are good. In fact, we're getting, 5.5% or more in all investment grade that we build into our what's called our T3 balance strategy. It's a strategy that mixes appreciation and income. But the yields can do more for you on the equity side because companies are raising their dividends. We've seen that a lot over the past year, and we expect that to continue. So not only do you get dividends, and if you look at something like a Blackstone or an AbbVie or an IBM, you're getting yields of 4 or 5 or more percent. And those yields are probably going to stay where they are. They're going to see increases in the dividends, and those increases in the dividends can help the investor see more cash flow come in over time. And that helps them keep up and perhaps stay ahead of inflation. In addition to getting the potential for appreciation, some of these companies that I just mentioned, we see them in good growing end markets, good moats around these companies, good pipelines. And so it's a combination of looking for appreciation potential in these companies and also, getting some of that income that helps people get through this high inflation period.